You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast.
Today, we're tracking a really fascinating collision in the global markets.
A collision, right? We're seeing this sharp domestic economic weakness running headlong into some pretty intense geopolitical strength.
Exactly. And the British pound is Exhibit A. It took a major hit following that dismal UK employment data.
Which has just accelerated expectations for a Bank of England rate cut. I mean, traders are suddenly talking about December again.
They are. But while sterling slumped, you had commodities just surging. Oil rallied on reports of Russian supply disruptions, and gold just keeps going well above $4,100 an ounce.
So today we're going to analyze that surprisingly dovish repricing triggered by the UK labor report and really dig into what's driving the strength in energy and precious metals.
And we also need to cover the new trade measures from China on rare earths and the wider geopolitical developments shaping risk. This all shows how local data can shift global policy while world events dictate commodity prices.
Let's unpack it. That UK labor report, it really did steal the show during the London session, didn't it? I mean, employment dropping by 22,000.
It absolutely did. For investors, this wasn't just some small miss. This was a flashing red light.
A signal for a fundamental policy shift.
A huge one. What we saw was the market delivering a really severe judgment on the Bank of England. That drop, plus the unemployment rate ticking up to 5%, triggered what we call a dovish repricing.
And for you listening, that just means the market started betting, and betting heavily, that the Bank of England has to cut rates much faster than anyone thought.
Right. It's not about if anymore, it's about when and how fast.
So we're seeing traders now fully pricing in a 25 basis point cut by February, and the odds for a move in December just jumped significantly.
And you saw it immediately in the price of cable. That's the pound against the dollar. It just slid, and fast.
That slide is a direct reflection of, what, a collapse in confidence in the Bank of England's timeline?
I think so. You even had one of their own policymakers, Mrs. Green, who called the data not great. She mentioned survey distortions were, clouding the picture.
But didn't she immediately try to walk that back? She followed up by saying policy must remain restrictive.
She did. She tried to jawbone the market back into line.
Which creates a serious dilemma for them.
That's a massive one. That's the tension right there. If the labor market is softening this quickly, saying policy must remain restrictive starts to sound like, well, just talk, not reality.
So the market is essentially calling their bluff.
The market is challenging them, yes. It's betting they can't hold the line if the real economy is slowing this abruptly. That's why the euro climbed so sharply against the pound. Investors are betting the Bank of England will be forced to move before the European Central Bank.
It's a fascinating disconnect. Because while the UK policy story is all about weakness, the commodity story is all about tightening and risk.
A perfect pivot. Let's talk about China.
Specifically, China's moves to control rare earth exports.
This is where that long-term structural risk is really coming into focus. This isn't just tweaking a tariff. They're implementing a strategic trade weapon.
Okay, let's unpack that because this has an immediate impact on, well, every high-tech supply chain in the world. Defense, electronics, green energy.
All of it.
So what exactly is this validated end-user system they're proposing?
You should think of it as a kind of gatekeeper, a highly specific one for critical minerals. China controls a dominant share of the world's rare earth elements. These are materials you need for everything from a jet fighter to a smartphone.
So this new system is designed to fast-track export licenses for certain buyers they approve of.
Exactly. It ensures supply to friendly nations or to specific industries they want to support.
And implicitly, it lets them choke off supply to countries or industries they see as adversarial.
That's the lever. It's explicitly aimed at restricting U.S. military access to materials that are crucial for advanced tech.
So this is a clear geopolitical move. It's not about profit.
Not at all. It's a signal. It tells you that supply chain reliability is now tied directly to your diplomatic relationships, not just market efficiency.
Which sets a very cautious tone for global trade. Even though we did see that little flicker of good news with Switzerland and the U.S. closing in on a tariff cut deal.
And that contrast really captures the mood. On one hand, you have these high-stakes restrictions on the materials of the future. On the other, you have classic tariff reduction on finished goods. It's a deeply bifurcated world.
Okay, let's turn to commodities, where the mood is the complete opposite of that damp UK labor market. oil prices just kept climbing.
All driven by escalating supply risk. We saw WTI crude and Brent hitting some pretty significant highs.
And the immediate driver seems clear. More supply vulnerability from Russia.
It is. Ukraine's military reportedly struck a Russian oil refinery in Saratov. When a key piece of energy infrastructure gets hit like that, the market instantly prices in a huge risk premium. It doesn't matter what the inventory levels are today.
That's a direct physical hit. But it was also movement on the purchasing side, right? With India.
Yes, and this underscores that long-term geopolitical risk. Reports suggest major refiners in India, a massive consumer of oil, have halted their purchases of Russian crude that were set for December.
And that's because of sanctions and payment issues.
Correct. And that decision puts immense upward pressure on global prices because that crude either has to find a new buyer or production gets constrained.
So you have military strikes on infrastructure and major buyers getting hesitant. That puts a real floor under oil prices.
An undeniable one, at least for the immediate future.
And all of that intense supply uncertainty seems to be feeding directly into precious metals. Gold pushed higher again.
Significantly higher. It touched what? $4,149 an ounce before consolidating a bit?
And the drivers here feel like a perfect storm for gold.
It is a perfect storm. The first driver is obvious. Geopolitical uncertainty. That's your classic safe haven demand. When China pulls a lever on rare earths and refineries get hit, investors run to gold.
But the second driver is what we started with, that renewed expectation for easier central bank policy.
Exactly. Lower interest rates mean the opportunity cost of holding gold, which pays you nothing, goes down. It becomes more attractive.
And the big banks are clearly bullish on this. UBS is suggesting 2025 gold demand could be the strongest we've seen since 2011.
And Commerzbank, reacting to all this, just lifted their year-end forecast for gold to $4,200 an ounce.
That shows some serious conviction.
It does. It tells you this isn't just some fleeting geopolitical spike. This is a rally fueled by a structural belief that safe haven demand is colliding with a global central bank pivot toward easier money.
Speaking of volatility, let's just connect some of these soaring commodity prices back to the broader geopolitical landscape.
Well, the key focus remains the Middle East. We're hearing about high-level diplomatic meetings, but we're also seeing significant long-term commitments being made.
Like the reports that the U.S. is planning to build a massive new base near Gaza's border.
A very large, $500 million base.
And why is a number like that relevant to our market analysis?
Because a $500 million investment signals a long-term, expensive commitment to regional stability. It's a physical manifestation of risk management. It tells you that stability, which is needed to keep shipping routes and oil flowing, is worth a very high price.
Meanwhile, the Russia-Ukraine conflict keeps generating that immediate price volatility, like the drone strikes we mentioned.
That's right. It feels like every major market move right now is being dictated by headline risk.
And yet European stocks actually opened a bit firmer.
Yes, and ironically, it was led by the FTSE 100, which actually benefited from that weak labor data. Lower rates are often seen as a good thing for future corporate earnings, so the STOXX 600 gained a bit, luxury and healthcare did well.
But the broader risk narrative still feels fragile, especially heading into this week's U.S. Consumer Price Index data.
Very fragile. When you synthesize all this, what really stands out is the vacuum effect. When a country's domestic policy credibility softens, like it has in the UK, geopolitical heat just rushes in to fill that space.
And commodities, especially gold and oil, become the clearest measure of that global instability.
They're the barometer for global instability and policy anxiety, all rolled into one.
So the insight for you, the listener, is to see how these forces are now integrated. They aren't on parallel tracks anymore. Domestic weakness is actually enabling commodity strength by speeding up that central bank pivot that gold loves so much.
That is the critical linkage. If you are watching any major currency or stock index right now, you have to be watching the price of crude oil and gold just as closely. They are signaling the risk premium being priced into every single asset. That covers the major moves and underlying drivers we saw during today's London session.
Appreciate you tuning into the Financial Source podcast, and we hope this analysis helps frame your thinking on the shifting dynamics of policy and commodity risk.
Join us again next time for more in-depth market analysis.